turning $10,000 invested in the stock market into $1 million is the most thrilling achievement I can think of for an investor like you and me. Sadly, it's not that easy to make it happen, but it's not impossible either. Today, I'll research 3 stocks to see if we can add a new 100-bagger stock to our portfolios. Hello, my name is Hoda Mehr. I'm founder and CEO of Stock Card, and I am obsessed with finding the next 100-bagger stocks for my portfolio. A 100-bagger stock is an investment that gives you 10,000% return. For example, if my parents invested $1.50 in Target on the day I was born, I would have had about 10,000% in return today when I'm researching this episode. 100-bagger stocks like Target tend to have a few things in common. They tend to grow their revenue consistently for several years, have found a business model that generates free cash flow that they can reinvest into their growth, and over the years, they improve their earnings potential, resulting in higher return on investment for shareholders. It's very rare to find a company that can do all that. Most rapidly growing companies tend to burn through a lot of cash, and many haven't yet found a way to generate free cash flow. As we learned in 2022, most growth stocks tend to fall in this category, making them mere gamble in the game to reach 100 times return. So to improve the odds of success in picking 100-baggers, I always screen the market based on a few common 100-bagger characteristics. My 100-bagger screener on our company's platform looks for such companies every night, and today's 3 stocks are from its results: Magnite, Roku, and Teladoc. Without further ado, let's get into the good stuff and research these 3 stocks. The link to all 3 stock cards and possible 100-bagger stock screener is in the show notes if you want to research with me or get to it later. And don't you forget, I'm not a financial advisor. This episode is based on my personal experience and is for education and entertainment only. Talk to a financial advisor, or better yet, educate yourself to improve the odds of success in your journey to wealth. Okay, Magnite, ticker MGNI. Using Magnite's automated software, content publishers such as connected TV programs or podcast platforms sell their advertising spots to the highest paying advertisers. It's commonly known as a sell-side advertising platform because it sells its ad spots to advertisers, and the market it operates in is known as programmatic advertising. The company's revenue comes from advertising sellers who get paid by the advertisers. Magnite focuses on the streaming platforms that make money through advertising instead of purely relying on subscriptions. This focus on ad-supported streaming has high growth potential and is a growing advertising market segment. We have even seen the king of streaming, Netflix, is now offering ad-supported streaming service. The company grew its revenue by 73% between 2019 and 2021, and even in 2022, the year that digital advertising took a hit, Magnite grew its revenue by more than 5% quarter over quarter in Q3. It's EBITDA positive, generates free cash flow. The stock is valued at 2.9 times its sales. If it manages to grow revenue at the same pace as the overall programmatic advertising market, which is expected to grow at 21% per year, in 5 years, the stock will reach its current valuation. This means that growing into 2.9 sales is achievable, and we can now buy Magnite at a reasonable price. What's concerning is the Magnite's debt versus its EBITDA. This metric shows how much leverage the company is using to grow. In the case of Magnite, its quarterly debt over EBITDA is above 6 times. Although its latest earnings report shows a continuous decline in its debt, this is one important negative factor we shouldn't forget. Another challenge is that the programmatic advertising market is expected to grow into a $20 billion market. Magnite's annual revenue of $500 million multiplied by 100 gives us a $50 billion revenue. So getting to 100x purely based on its revenue growth is impossible in the market. Of course, we don't expect Magnite's market cap growth would only be the result of its revenue growth. As a matter of fact, the 100-bagger stocks tend to get higher valuation multiples as they grow. However, the programmatic advertising market may be small for one company to grow into 100x. Unless it expands in its adjacent markets. Overall, Magnite is moving in the right direction. We have to return to it after we know about my 2 other 100-bagger candidates. Let's focus our attention on Roku, R-O-K-U. Many of us are familiar with Roku now, but not too long ago, the company was widely presumed as having no chance over streaming platforms such as Netflix. I clearly remember walking to my parents' place, seeing a Roku TV on the wall, and being so surprised that the company was finding its way to people's homes. That's when I first picked it up in March of 2019. Roku started as a little device you buy to stream any streaming content on your TV from Netflix to YouTube. It now has its own TV sets and audio devices built for streaming. Roku acquires customers who use Roku TV to stream television content. It tries to increase the number of hours those customers watch and then make money by selling them advertisements or subscriptions. To me, investing in Roku is like investing in Netflix when streaming was just about to take off. The share of connected TV in advertising spending in the US is growing steadily, and the number of connected TV users between Gen Z and millennial generations is expected to grow too. Those forces bring organic growth to Roku. That's why the number of active accounts and the number of hours of streaming on Roku grew steadily even in 2022, despite people returning to almost normal lives past the pandemic. Operationally, Roku is acceptable with some concerns. Revenue and EBITDA, or top line and bottom line, have been growing rapidly aside from the last year. For example, you can see annual EBITDA was growing steadily until it turned negative in 2022. The same trend is visible in the free cash flow. Steady annual free cash flow growth disrupted into negative free cash flow in a few of 2022 quarter results. R&D costs in sales and marketing have jumped significantly too in the last few quarters, although it can be justified by the launch of its TV lineup and other hardware. This brings me to another concern in addition to 2022's negative results. I don't like the company's expansion into smart home market by introducing doorbell cameras and smoke detection alarms. Roku is justifying it as they are adjacent markets to its already existing manufacturing skills, relationships, and capacity. But to me, it is a deviation from the core connected TV business. Aside from those things, the company's valuation is reasonable with a 2.5 times price to sales ratio. At $7 billion market cap, if Roku manages to grow as much as Netflix with $160 billion market cap, it may be able to achieve 25 times in return. Before we move to the next stocks on our list, we have to talk about the elephant in the room. ARK invests strong conviction in Roku's future growth potential. Roku is one of the top holdings of RKK's ETF, so I had to dig into their reasons for such strong conviction. According to ARK's latest forecast model for Roku, the stock price can range somewhere between $100 to $1,493 per share. As a reminder, Roku is now hovering around $54 per share at the time of recording this episode. So ARK Invest believes there is between 2 times to 30 times in upside potential in the next 3 to 5 years, which is not too far from my assumption that Roku's growth ceiling can be somewhere around Netflix's current valuation. ARK's assumptions come from the steady global growth of connected TV and Roku's active accounts and higher monetization per active user through video advertisements. Even the launch of Netflix ad-supported service can grow engagement and monetization for Roku because it is agnostic to which streaming content brand its users are watching. I recommend digging into ARK's Roku forecast on your own, even if it is only to learn how a professional fund manager researches the stock. I leave a link to this file in the show notes. Moving to the next stock on our list, Teladoc. Before we even start talking about Teladoc, let's address everyone's inner voice that wants to run away from Teladoc because the stock is down almost 90% from its all-time high of roughly $290 per share. To calm our inner voices down, we have to discuss 2 things. 1, investing is always a forward-looking activity. It really doesn't matter where the stock has been. What matters is where it's going. And 2, we haven't yet researched the stock together. That's why we are here. We must understand why a stock price has fallen by 90%, what caused it, and whether the reason for it is still true. So let's start from there. The obvious reason for Teladoc's stock price decline is that it was a part of the so-called stay-home stocks. After the COVID pandemic hit, almost all visits to hospitals, doctor visits, and medical facilities halted. Visiting your doctor was only possible through a telemedicine platform such as Teladoc. Investors rushed to buy the stock first, and consecutively, they rushed to dump it when the pandemic was over. Many argue that with the pandemic gone, no one needs telemedicine much. However, if you think about the telemedicine industry, the technology can save healthcare providers a lot of money, and it is not dependent on having a pandemic forcing people to visit their doctors remotely. All healthcare providers want to save money, and the studies have shown that telemedicine can save healthcare providers up to $1,500 per person per visit for high-cost healthcare services such as emergency room visits. If you don't have to walk to a medical facility and can get access to the care you need, it translates into savings for the healthcare provider and a more comfortable experience for you as the customer. That cost saving is the driver behind the telemedicine industry and Teladoc. Now, let's forget about the pandemic and look at it with a wider time horizon. In December 2019, before the pandemic, the stock price was hovering around $80 a share versus $27 a share at the time of recording this episode. Is the company's financial status worse by roughly 66% now compared to 2019? That comparison is where the real answer hides. Between 2019 and 2021, Teladoc's annual revenue was up by 91%. The revenue increased by 3.2% in the latest quarterly available data, translating in 12% annualized revenue growth. So when the stock price was down by 60%, the company grew its revenue significantly. The company isn't profitable. However, its negative EBITDA shrunk from $437 million 2 years ago to $84 million negative last year. More importantly, it generates free cash flow now, which means the company has found a business model that makes money, fueling its ability to cycle money back into business growth. On the negative side, I don't like that it has $2 billion in total liabilities and only $1.5 billion in cash and equivalent, but with current asset to current liability ratio above 3x, it is in no immediate financial trouble. And again, its return on equity is negative, which means it hasn't been returning value back to shareholders for every dollar of shareholder equity, but the negative values has shrunk every year or quarter. It's almost as if Teladoc is on the verge of turning fortune around in the stock market. Currently, the stock is priced 2 times its sales, which is a typically reasonable price-to-sales ratio for the market average. Moreover, Teladoc operates in the telemedicine market, which is forecasted to grow 24% annually. If the company grows as fast as the market in the next 3 years, it will already grow into its 2 times sales valuation with much room to grow beyond it. This gives me confidence that the stock is reasonably priced, if not undervalued. Now, does Teladoc have the chance to grow 100 times? Its market cap is around $4.7 billion at the time of recording. To deliver 100x, it has to grow to nearly $470. Incidentally, that's roughly United Healthcare's market cap. Assuming Teladoc can grow into a large healthcare provider such as United Healthcare, it's good to know that there is enough market opportunity to get to 100x. So let's summarize. We looked at Magnite, Roku, and Teladoc to discuss which one can be the next 100-bagger stock. Magnite's issue was its high debt and low growth potential of its market compared to how much it needs to grow to generate 100 times in return. Roku is in a much better position, but the growth potential in the best case scenario is around 30x. Teladoc operates in the healthcare industry, which has much room to grow. It is also moving in the right direction by generating free cash flow and shrinking its negative EBITDA, and it is priced reasonably at roughly 2 times its sales. Of the 3 companies, Teladoc has the highest possibility to grow into a 100-bagger in my analysis. Before we wrap up, I have one more critical analysis to do on Teladoc. One habit that has helped me to make better investment decisions over the years is to ask myself where my blind spots are in my research about a stock. This helps me find a risk and avoid what's known as confirmation bias in my decisions. This is when an investor tries only to find data points that confirms his point of view, which is one of the main mistakes most individual investors make. If you want to learn more about the top mistakes individual investors make and how to avoid them, make sure to watch the next video I will be publishing on the channel soon. And don't forget to subscribe to the channel to get notified when that video is out. But for now, for Teladoc, my blind spots could be in a few sections. Firstly, the company's management may have judgment issues. The evidence is the $18.5 billion acquisition of Livongo in 2022 and the consecutive $6.6 billion write-off in 2022, which means the management is really not careful about how to allocate their resources. The company's moat may not be strong enough. Moat comes from having a strong brand, efficient operations, and high switching costs, among other factors. The company does have a solid gross margin of 60% or so, but there is competition and it's not too difficult to switch between telemedicine providers, especially as it is still building its network of doctors and providers. If I were to invest today though, I'm okay with taking risk and monitoring my blind spots. Therefore, I would invest some in Teladoc, monitoring how it grows its revenue and free cash flow and watch for its debt not to get out of hand. If I wanted to be more conservative, I would invest some in Roku and monitor its revenue compared to competitors and whether it can go back to generating free cash flow. I should say that I own both shares of Teladoc and Roku primarily through my ARX investment, which owns both companies in its top 25 holding. I invite you to watch the 100 Bagger series of videos on the channel to learn more. And if you had a chance to play with the screener tool I used today to find possible 100 Bagger stocks, let me know your preferred 100 Bagger stock from the screen results. The link to both the 100 Bagger series videos and the 100 Bagger stock screener is in the show notes. See you next time.